Hey, what's going on YouTube? We are going to go through Walgreens Boots Alliance, ticker symbol WBA. Also, we will be doing a couple other stocks this weekend yet, two that are in a pretty interesting technical pattern that could be some pretty solid buying opportunities, some pretty decent companies as well. But nonetheless, so Walgreens currently sitting really close to a 52-week low. We can see 52-week range is 1462, which is probably pretty close to maybe a 10, 15, 20-year low. We can go 10 years out. Let's see. So we're even 10 years out. We're sitting well below a 10-year low. But on the 52-week range, sitting at just above $14.62, currently sitting at $16.22 per share. And year to date on Walgreens down 38%, and over the course of 1 year down 46.5%. So Walgreens did report earnings March 28th. They, on their normalized EPS, they beat, but on their GAAP actual EPS, which is kind of a little messed up on this particular quarter, missed by $7.20 because of a goodwill impairment charge that they took. And revenue surprise, though, did beat by $1.2 billion. And there has been 11 EPS revisions in the last 90 days. 10 of them revised lower. One of them had been revised up higher. So for the next few quarters, we can probably expect some weakness. Expectations are pretty low in the next coming quarters for Walgreens. So on the earnings call, there was about three things I highlighted here that I wanted to kind of go over as we go through this. Second quarter loss per share was $6.85. Second quarter results included $5.8 billion after-tax non-cash impairment charge related to Village MD, which was a goodwill impairment charge there. And then they're narrowing fiscal 24 EPS, adjusted EPS, mind you, of $3.20 to $3.35 per share. They are in the early wind down stage of their sale leaseback program. And they also are claiming lower earnings due to their Cencora share sales, offset by execution in pharmacy services and a lower adjusted effective tax rate. And then also, they remain confident in their goal of achieving $1 billion in cost savings this year. Again, another thing we'll kind of look through once we get over into their financials. Hopping over into the valuation spreadsheet, kind of gives us a big picture view of how the company has performed over some time, going all the way back to 2015. And we got a revenue, gross profit, and net income chart here all combined into one. We got a revenue, you can see grows relatively every year over year there. We got our gross profit, which you can kind of see is flat to slightly down. Then we got our net income on its own chart here, which is down, was pretty consistent around 45, maybe $5 billion roughly. And then now we're seeing negative net income of well below $5 billion. And then we come down to margins. Company used to have 26% gross margins, all the way down, at least in the last quarter, of 17.3%. So if you look at that, trailing 12 months, 18.2. Just in the last quarter, they've lost even more margin yet. So company is not doing a very good job on margins, at least on gross margins right there. And their net income, obviously, not doing very good either. Net margins, company, 4% range and negative 16%. Obviously, that has a goodwill impairment charge included in it. So that makes that look really bad. But once we kind of break down the numbers a little bit more, still negative net margins. Return on invested capital, low. We've got a PE ratio currently negative, obviously, because they're negative earnings per share. Cash to short-term debt. Short-term debt continues to grow. They did get rid of some short-term debt, but it still is continuing to climb right back up. Cash to total debt here, their total debts just continue to grow and grow and grow and grow, and their cash position just does not. You can kind of see this tiny little blue bar down there. It's like no cash at all on the balance sheet. Then we come over here to free cash flow, and free cash flows just continue to decline. Even in a declining cash flow environment, they still continue to raise their dividend year over year. That's not very smart, in my opinion. Obviously, you were known as a dividend paying company, but you got to stay afloat. You got to make sure you're making money. And if you can't afford to pay these dividends, it just doesn't make sense to pay them out at all. Capital expenditures continue to kind of climb and grow, starting to maybe level off, maybe shrink a little bit. That's not in line with what they're saying on their goal of achieving $1 billion in cost savings in the trailing 12 months here, where we have cut some costs, but not nowhere near $1 billion yet. And they could be looking to cut costs in other areas of the business besides just capital expenditures. But again, we'll look through that once we get to their 10Q. Share counts staying consistent, 863 million shares outstanding. And dividend, we have, this is only up to 2023. Dividend has been cut in half. I think it's sitting around $1 per share, if I'm not mistaken. Yeah, so we got a dividend rate of forward of $1 per share, 25 cents per quarter. So overall, we can see the financials. They've got some work to do. They've definitely got a lot of work to do. So now we're going to take a look at their 10Q and see how their last quarter was. See if things are turning around or not. We are looking at the balance sheet for starters and cash equivalents. They got $668 million in cash. This time last year, they had, actually in the last 6 months, they had $739 million in cash. So they burned through a little bit more cash, but still holding consistent cash position at the moment. We come down here to non-current assets. Goodwill was sitting at $28 billion. This is where they had some of that impairment charge that we just read off with, just that Village MD was like $5.8 billion of this $13 billion that they pulled from their assets as a goodwill impairment charge. So that is going to hurt their net income significantly. But their cash flows will go back to a normal cash flow because we get to add back in this impairment charge. So we get to actually see what the company, how much money the company actually made this most recent quarter. I think it might be 6 months, but we'll find out in a minute. So overall, cash is $668 million, $25 billion in short-term debt, which we can see right here. And there's nothing we can take out of here to make it look better. There's no deferred income or anything like that in this section here. So overall, you minus off $668 million from $25 billion in debt, you did nothing to that overall short-term debt position. So it's kind of scary to see $25 billion in short-term debt, which is due within a 12-month time frame, and only $668 million in cash. And then you add in total non-current liabilities of $44 billion, which gives you about $69 billion in total debt, with only less than $1 billion on the balance sheet. Not good at all. Then we come down to our income statement. So we got sales, which are up quarter over in a 3-month period, year over year, up about $2.2 billion. Cost of sales also up $2.2 billion. So if they're trying to cut costs of sales didn't go anywhere at all there. And we can see gross profit overall slightly down quarter over quarter. We look at this in a 6-month period, and we can see gross profit actually slightly lower. And then we've got SG&A expenses in a 6-month period, looks really good, cut off about $6 billion. But we come over here in the 3-month period. In this time last year, we were 6.9. This time this year, we're $7.2 billion. So it didn't cut any costs there, obviously. So costs went up $1 billion in the last quarter. And then here's our impairment of goodwill, which is going to get added into, well, actually subtracted from our net income of $12.3 billion. And we can see you take your gross profit minus your SG&A expenses, you're basically going to be negative $900 million there. Then you add in also your impairment goodwill charge. You got operating loss income of $13 billion. Overall, we come down here, net loss of about $6 billion. And then this time last year, $700 million positive. And then we come over here, we can see in the 6-month period, even this time last year in the 6-month period, still negative $3 billion. So these, their net incomes are not getting better yet. Even though there is this impairment charge, you still are not showing any progress, at least what we can see right now. So then we come to our cash flows. So now we got our negative net loss of $12.6 billion. We get to add back in our impairment charge of $13.5 billion. So that balances everything out there. So overall, we're left with negative $900 million cash from operating activities. This time last year, $1.2 billion. This is in a 6-month period as well. And then we also have our capital expenditures that we got to subtract from our cash from operating activities to give us our free cash flow. So we add negative $900 million plus negative $800 million gives us roughly $1.6 billion in negative free cash flow in the last 6 months. And then you analyze that, you're negative $3 billion roughly in free cash flow, potentially this year. And then we scroll down a little bit further, we got proceeds from sale leaseback transactions, which is they netted $700 million. And then they also added sale of other assets of $1.3 billion for a total of $2.2 billion more. So they scraped together another $2 billion. So they're trying to sell as much assets as they can. They're trying to get as much cash as they can because this company is hurting. It's hurting. It needs money. It needs money bad. And if they can't do it, this company's, man, it's probably headed for bankruptcy. Honestly, I feel like this is probably one of those that might end up in the BK category. We got proceeds from debt. They took out $15 billion, and then they had payments of debt of $14.9 billion. So basically, you took debt, you borrowed debt to pay off debt, and that's kind of scary as well. You're borrowing just to pay off debts. And then cash dividends, they still paying $800 million in cash dividends. Really, I think they should just eliminate the dividend entirely because they cannot afford to pay out a dividend right now. Basically, they're trying to scrape together some cash just to keep paying dividends, keep shareholders getting paid their dividends and happy, but I think it's doing more harm than good, honestly, in my opinion. So back to our valuation spreadsheet. We're going to do a comparable from CVS to Walgreens. We'll scroll down here to our charts. Kind of get an idea of the margin comparisons between the two companies here. We got our market cap differences here. We've got some revenue. We got 5-year growth rate on EPS and revenue. We can see CVS is forecasted for some much better overall growth in the next 5 years. We got gross margins. Walgreens, much better gross margins than CVS in the current time. Not sure if there's something going on there that's causing them to see negative gross margins currently, because we can come over here and see operating margins are positive. So there might be a little something that might need to be dug a little deeper into on CVS there. It might be just a one-time charge or something that's going on there. But we got operating margins on CVS positive 3.5% and Walgreens negative. Profit margin, we know Walgreens is negative, and profit margin on CVS positive 2%. Free cash flow at CVS, though, it kind of looks like the early stages of Walgreens. Where Walgreens used to be is where CVS is now. CVS is looking like it's like Walgreens used to be, with positive free cash flows, positive margins and whatnot. And then we're sitting on a PE currently on CVS of 10.5. Walgreens, obviously, negative earnings per share, so we don't have any PE ratio at the current time. So in comparison, you look at CVS compared to Walgreens, CVS is a lot better. It's got much better everything. You got free cash flow, so they can afford to pay their dividends. They have margins that are positive, and they're forecasted for some growth. So is Walgreens, but CVS is a much better financial position that we can see. So over to the calculator. So we know Walgreens currently is negative. So we're going to type in the forward EPS of $3.22. So come over here and type in $3.22 per share. And after we type in our EPS there, we then see a growth rate of the next 3 years of our EPS of about 4.8%. In the next 3 years for an average EPS growth rate, which gives us a P/E fair value of $16 per share. Multiples comparing to CVS, looking at $33.71 per share, and probably the highest manual PEG ratio I've ever seen of 184 years before this company earns its current market cap. We got price to book, 5-year average 1.3, currently sitting at about a 1. Got a PEG ratio. This would be a forward-looking PEG of 1, so I can't tell you on a PEG basis, fairly valued, slightly undervalued there. Graham's valuation, $42.47 per share. Dividend discount model, $16.68 per share. DCF valuation. So we know currently they are negative free cash flow, so we will not utilize this particular calculator in this final valuation. Down to Rule 72, we have 3 sources of growth rates here for an average growth rate of about 2.3. So we get to double our current EPS about 0.3 times. So really, our future EPS is not quite 7 because that's a double. So we're probably looking at more like a 5, if that, on a future EPS basis here. So that gives us a fair value of $5.74. So again, we get to take off our DCF valuation here because we know we are negative free cash flows. So once we subtract that off, that gives us a fair market value of $23 per share. A 30% margin safety is basically where it's trading right now. And analysts have a price target on this one of $25.69. So we are pretty close, slightly under where analysts are for a fair market value on Walgreens. So let's hop over to the stock chart, see how this thing is doing technically. So we are on a weekly chart here. And we've got these two trend lines here. We've actually got a couple more trend lines beyond just these two, but we'll draw this one in orange here, maybe make it a little thicker. You can see better. So we can see we are locked in a downtrend. We've got this other blue line up here, and we're on the bottom end of this downward channel. And every time we do get to this channel, once this orange line here, we do bounce off. You know, sometimes we break through, well, we bounce out, but we still bounce out. We don't make our way back up to the blue line. So that kind of gives you an idea that the strength in this one is not there. We also have another set of two more blue lines down here. We got one at about $16 here. Turn that one red. We can see we broke through what could have been a support range there. We can see, where did this come from? This came from the beginning of time. Actually, we could scroll this down here to 1538. So if you look at that, so Walgreens went public in 2009. Our 52-week low was $14.62. So when Walgreens went public, we have broken below Walgreens IPO trading price. Whenever you IPO, you typically pull back anyway. And we broke through the all-time lows on Walgreens. So Walgreens officially made all-time lows, $15.38 per share, and $14.62 all-time lows on Walgreens. But overall, we can see this. If there was a place to buy, there's probably a lot of stuff priced in, negative stuff priced in into Walgreens right now. I'm sure a lot of people are just not interested in this stock, to be honest. You do have a good dividend yield of like 6%, but you are trading at all-time lows on the stock. The financials are a complete mess. And I think if you wanted to buy this one, I would probably just trade it. I probably wouldn't do a buy and hold on this one because, you know, this thing could go to zero. I kind of believe that this company is probably going bankrupt just based on the financials. Maybe they can turn things around, but it really just does not look good for Walgreens going forward. So even though our fair market value is $23 per share on this one, I still don't believe this is one that should be bought personally. That's my opinion. That's what I'm not. This is a stock that I'll stay away from. I'll probably just I'll stick my money somewhere else where I think there's still life left in this company. But that is it for Walgreens. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.